Morning, everyone. Thanks so much for joining us. We're just going to give it a few moments. Sorry, we had a few technical difficulties, but we're here now. So just a few moments while we let everyone join us as I see them in the wait room here. Just a reminder, this webinar is being recorded. So for any reason you have to leave or you know, people that couldn't make it, they'll be receiving it later. We'll try and get it out as soon as possible. If there's any questions, don't hesitate to put them in the Q&A section, and we'll try and get to those as many as we can too throughout or near the end. If there's some that come up with the questions that Shaf is answering throughout, he might touch on some of them. So just a few more minutes while we let the rest of the people join. And just to make sure audio is working, can someone just give a thumbs up in the Q&A? Perfect. Thanks so much. Thanks, everyone. Probably about half a second here, Shaf, and then we can begin.
Okay.
We did want to thank everyone too who sent in questions for this webinar today, either via ir@victorysquare.com or through the Discord as well. We've received quite a bit of questions, so we're really thankful for that and looking forward to answering all your questions today. So I think we will begin. So without further ado, we just want to welcome you all and thank you for joining us for this month's investor webinar with CEO Shafin Tejani.
Yeah, thanks. Thank you, Abby, and thanks everyone for tuning in. Before we get started to the questions, I'll do a quick kind of just recap and intro on Victory Square in case anyone's new. Victory Square provides investors with a liquid way to invest in early stage tech and healthcare companies without buying a venture fund that normally requires accredited investor status or multi-year commitments. Victory Square stock can be purchased by non-accredited investors who are restricted from buying venture funds. And it's an excellent way to diversify into early stage venture. We have two really big advantages. One is that our entrepreneurs and our companies are coming from all over the world, through our internal incubator, which has relationships with accelerators all around the world. So we're poaching some of the best talent and best companies. And the second is we're not passive investors. We roll up our sleeves and get active within our portfolio companies. So we've got a strong internal team and a team of advisors that get involved and really help our portfolio companies, give them a competitive advantage to grow and scale faster. And lastly, management is aligned. As we all have, significant holdings in VST. We have about 25 portfolio companies. I think 7 have been kind of spun off, and we're tracking it around a 9x return on cash invested. So just a quick kind of summary on Victory Square. Today we pushed out a corporate update, so I thought again just really quickly kind of run through some of the main points on that before we get to the questions. First highlight was just the unaudited NAV report. So what we've tried to do this year is on a more frequent basis, just update investors on where our NAV is tracking, and it was around 80.1 million Canadian dollars as of the end of September 30th, 2022. Just to break down the way we calculate our NAV, our portfolio companies are broken into 3 categories: public, private, and incubating. And for taking value, we look on the public side, we basically just look at the last trade, and we multiply that share price on the last trade by the number of shares we have in a particular company to kind of calculate that value on our public holdings as part of our NAV. On the private side, The majority of our private holdings are priced by a third-party pricing agency, and so as part of our annual audit, our auditors, request us to do that, to hire an outside firm to basically, give us their opinion after due diligence on our portfolio companies as to what the value is. And the third is incubating, which generally we take either our cost or kind of a management reviewed valuation, and that's what makes up that number. Earlier in the year, we actually did a specific webinar on our NAV where we kind of broke down that, and we'll probably do another one at the end of the year so investors can actually see, company by company how the valuations are determined. We also announced a change of auditor. So Victory Square had been using the same auditor for a number of years, and as our company grew and the number of portfolio companies grew and the spinoffs grew, we realized that the old auditors, our file was too big and too complex for them. As a Canadian company, we're operating in different sectors, in many different countries, on a global scale, dealing with tax and employees all over, exits, multiple currencies. And so we really needed to get a Canadian-based firm with that was strong, with a strong international presence. And so we were very excited to get MNP as our new auditor. So the reason for the change of auditor was, we'd used the same auditor since inception, and our file just grew too big and too complicated for them. And now the resources that MNP has, both locally and globally, I think are going to be super advantageous to BST on this, next chapter of our journey. We mentioned a couple of notable portfolio highlights. Some of these portfolio companies we'll get into a bit deeper as I noticed some of the questions around them, but just high level. The first company was IV Hydrate. For shareholders, this is going to be a big focus for Victory Square and our team on a go-forward basis. There's a couple of questions around Hydrate, so I'll get into more detail on those questions. We touched upon Game On. We're very bullish on Game On. We're a large shareholder of Game On. Right now, our team provides strategic guidance for them, and very bullish on the Karate Combat NFT and the Teddy Yum music product that Game On's built. And if anyone hasn't registered, I think Game On's got a webinar tomorrow. I'll ask Abby to include the link in the notes, but check it out, and you'll be able to hear directly from Matt Bailey. XR Immersive. Again, our team has been providing strategic guidance. Really excited about this new kiosk that they introduced last week at IAPA, which is a large immersive experience expo in Orlando, and a new proprietary game that they're building in their existing SVR system. Stardust Solar, we mentioned they've had 100% year-over-year growth, tracking well. Again, really strong team, and that's a company that some of our team has been kind of working with actively, really pushing for them to list next year. And then we mentioned a couple of others. Victory Square Health, which operates under the name Safe Test in Brazil. They've really been taking advantage of this first mover advantage that they have in Brazil, leveraging kind of the team and some of the traction that we've had here in North America in the digital health space for them to be kind of a market leader there. We announced a transaction with Draft Label. So after Hydrate lists, Draft Label is on deck to be the next company that lists, which will most likely happen in the first half of next year. And then we mentioned a couple of the other portfolio companies which are doing well, like Fans Unite, Next Decentrum, Copilot, Cloud Advisors, and some others. So we wanted to kind of just again give an update and highlight on all of them. If anyone hasn't checked the news yet, that corporate update went out this morning. So please look at it after the presentation. And if there's any questions on that corporate update or after the Q&A, please feel free to post the questions in our Discord channel or to message IR at victorysquare.com. So let's get to the questions. Abby, do you want to look at what was sent in?
Yeah, I'm just going to post the corporate update for everyone in the chat as well, so you guys will have access to it, as well as you can find it on our website too. And then for Game On, he mentioned the Game On webinar. Shoot us an email at ir@victorysquare.com and we'll make sure that you're added to that list. The webinar is tomorrow at 10 a.m. PST or 1 p.m. Eastern, just so everyone is aware. And yeah, let's start with some questions. So here, let me just pull. So there's some great questions here. First one, how does your background prepare you for your current capital market where credit is no longer easy to acquire and interest rates are much higher?
So, I've been through two major downturns previously. So, the dot-com bubble burst, the 08-09 kind of financial crisis. And, again, the big key learning in both of those, there were a number of key learnings, but one of the biggest key learnings was, I saw that companies that had enough cash to survive the downturn, prevailed over time. Now, there were a lot of other characteristics, but I think it was ensuring that those companies were in, good financial shape where they had runway and they had, worked to really trim down their costs and operate extremely lean and kind of focus on their core competency. So from a Victory Square perspective, I think we started to anticipate, an economic downturn, I think early in Q1, Q2 of last year. The markets had gone, kind of bananas. There's that Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful. And, we saw, everything going up. There's a lot of capital flying, a lot of companies we believe were significantly overvalued. And so at that time, we decided internally to do a couple of things. And a lot of this was based on having kind of lived through two downturns. And it really revolved around ensuring that our companies were had cash to kind of withstand any sort of long downturn. Two, that they'd cut their costs and really leaned out. And the third was to ensure that they were focusing on some of their core IP as opposed to taking, risks, during this kind of this kind of time period. And so, a couple of specific examples of what we did. I think we accessed non-dilutive strategic debt. So in the case of VST, Game On, VRAR, Copilot, and I think Fans, all the companies we insured were, in a position to be able to access, strategic debt that was non-dilutive. Because we've seen companies, when you're desperate for capital and you've run out of capital, they've taken on really dilutive financings, which hurt investors long-term. So that was one example. And I think we started to, secure that debt for companies at the beginning of this year, end of last year. We also, through strategic equity financing. So, IV Hydrate, Draft Label, Next Decentrum are examples of companies that did, strong equity financings to ensure that those companies were capitalized, if there's any sort of prolonged kind of downturn. And we also, other companies like Stardust and SafeTest, really, we help them focus on non-dilutive and, government grants. So one of the, having lived through two experiences, one of the biggest things was ensuring that the companies were in a strong cash flow position. And then, obviously operating lean, focusing on their core IP and not really taking any sort of undue risks. I want to touch on a couple of just like, high level things, because I think it's important for both companies and investors right now. Through both of those cycles, and even today, one of the things that we talk to, internally to our team about and our companies is, there's almost kind of three things that you really need to do during these periods. One is to get your mind right. The second is kind of get your house in order. And then the third is to put together a game plan that works for you and, kind of go on offense. And, a lot of times that first point of getting your mind right, a lot of people panic during any time of crisis, and they almost go into that, Chicken Little, sky is falling. Some people freeze and are in the, in the fetal position, but we really believe that, focusing, getting your mindset right, and being able to, get your house in order and put together an action plan is the most proactive thing that you can do. History is cyclical. The other key learning from those two cycles is that, like, we emerged from it. Like every time there's crisis, there's this cleanup. The cleanup might take 12 months, 24 months, 36 months. but things always get back to things always go up, especially from a market perspective over long periods of times. And so you can look at past recessions and downturns and all of those different types of things, and things have gotten better. One of the things too, I think, from an innovation perspective and from an investment perspective, you've seen a lot of really exceptional companies come out of these types of downturns. The companies that were able to kind of withstand any sort of downturn because they had a good capital position, or they had strong talent, or they really doubled down or focused on their core IP or product. And you've also seen investors. Entry points are great. Like I mentioned, last year in Q1, everything was going up. A lot of garbage companies were going up, and now as an investor, you really need to do your DD, but you can find really good entry points as opposed to what entry points we're looking at in Q1. And so during these downturns, we've seen tremendous wealth created for investors that, again, are not just investing blindly, but, have picked some high conviction bets and got really, really good entry points into those businesses. And, I think everyone's North Star is different. So really kind of figuring out what your focus is during this period. For some people, investment's not a focus. It's, taking care of family or getting their own kind of house in order. But, I think what we've told all of our portfolio companies, and we started telling them last year, was, make sure if a downturn's coming, make sure you reassess your investment business model, to determine what are the short and long-term impacts of what's happening, globally from a macro perspective. Do you have enough cash? Where's your burn at? Are there new sales coming in? Do you have accounts receivable? Get on them. Because, developing a strategy is really important. Hope is not a strategy. Like, I think a lot of people just hope things get better. And we've seen that inaction is not a strategy. I think really, digging down, whether you're an investor or a company, in this space to put together an action plan. And I think when you have that game plan and your house is in order, you can go on offense. What we noticed from a Victory Square perspective is when we started doing that from a parent company perspective and trying to instill those same things in our portfolio company, it's putting us in a position, and some of our portfolio companies in a position, to actually go on offense. As companies run out of capital, or, good companies run out of capital, valuations come down, you start to see a lot of consolidation and really good M&A opportunities. So, I think for whether you're an investor or a company during this period of time, I think one, stay positive. We will emerge from this. 2, get your house in order. And 3, put an action plan together that can help you go on offense and take advantage of, a lot of opportunities that kind of present themselves.
Perfect, thank you. Let's move on to the next question here. Can you reassure shareholders that you won't need dilutive funding to keep the business running and increasing in value?
Yeah, I mean, I can confirm that Victory Square has no plan on, doing an equity financing at these price levels. I think in a previous webinar, we kind of mentioned that, our business model is to buy, build, invest in early seed stage tech companies. Then we spend 12, 48 months with those companies, to get them ready to be spun off or stand on their own. And then it's during those times that, we do one of 3 things. We take money off the table at a significantly, higher value than our cost base, which we can then use that capital to reinvest in top of funnel. And we did that, I think when in early 2021, in the case of Fans United and Argo, where both were trading well, and we took some money off the table to reinvest. So again, no dilution to VST to be able to make those investments. 2, in the past, we've done an equity financing and raise, and we did one in November of, I believe, 2020 at around 52 cents a share. And I think our stock price was maybe trading around 60 cents a share at that time. I can't remember exactly, but at that time, it made sense for us to do an equity financing to diversify our shareholder base and bring in capital to, again, take advantage of opportunities that we saw at that time. So that's when it made sense to do a dilutive equity financing. And then the third is, which is what we've recently done, which is, again, be able to utilize our assets, to raise debt, strategic debt against. And we did that earlier, I think in Q2 or Q3, maybe it was September. where we brought in $2 million of strategic debt, secured by our publicly traded holdings. Again, non-dilutive, and it gave us VST enough capital to kind of we've got a very low burn on the parent side, so this gives us a ton of runway.
Perfect, thank you. Shareholders are concerned about the 2-year low stock price. Why aren't you concerned?
So the way I can answer that is the team and I are very upset with the share price. There's no doubt about that, but we're not concerned. The reason we're not concerned is that the net asset value of the company is significantly higher than the market cap. And like I mentioned in an earlier question, like this has been verified by a third-party pricing agency that comes in and values our assets. This second reason why we're not concerned is we believe the future prospects are brighter that they've ever been, and specifically around a company like IV Hydrate. So, our business model is based on identifying opportunities early, mitigating risk towards creating outsized returns. The goal is to find outliers in our portfolio and our investments, and we believe IV Hydrate is one of those outliers. With respect to share price, we've seen a significant decline in large, small, and microcap stocks across the boards. We expect continued volatility, on the equity markets for the next couple of quarters. However, we know the markets will come back. We just don't know when they'll come back. So for us, the best thing we can do is to, focus on, ensuring that we have good capital runway so we can withstand any downturn. Two, really be focused on keeping our costs as lean and tight as possible. And the third is focusing on our winners, our core businesses, like an IV Hydrate. A lot of companies will go under and fall by the wayside, but I think others like VST, like us, where we have significant assets, a healthy balance sheet, runway, a successful businesses, and a team that can execute at a high level, we will not only survive but thrive during this period. And when markets come back, our share price will come back as well, and I'm confident our long-term investors will be rewarded from that. So we're upset at the share price, but we're not concerned because the underlying fundamentals are strong.
Thank you. Why did VST change auditors? Came up a few times.
Yeah, so I think we touched upon this. I think in the corporate update, our file became too big and too complex for the old auditors. We're a Canadian-based company. I mentioned operating in different sectors in different countries. We're employing people. There's multiple currencies that we do business in within VST and our portfolio companies. There's tax implications. We've had exits and spinoffs and dividends, and we needed a top-based Canadian firm that had a global network to kind of really optimize and maximize our account long term. And so that's why we made the move. It was in the best interest of VST kind of on an ongoing basis to kind of transition from a firm that we'd used, which is, again, was a local small firm here in Vancouver.
Perfect, thanks. Now we're going to switch it up a bit, as we've seen quite a bit of questions regarding Hydrate come in. So you've mentioned Hydrate being an outlier in the portfolio. Can you elaborate on why you're excited about its potential?
Yeah, I mean, this is probably the most exciting portfolio company, not only today, but that we've had kind of within the portfolio. I'll take a step back. Our business model at VST is starts by identifying a significant opportunity. We then buy, build, or invest in taking advantage of that opportunity. Working to reverse engineer a roadmap to a future goal that we have with that investment. And in a lot of those cases, we step in, provide all the resources, cash, talent, tech, to give the investment the best chance of success. Now, specifically with Hydrate, the digital health space, at-home care space, and the nursing space were where we initially saw a really big opportunity. And in, I think, January of last year, we acquired 100% of Hydrate, I think for around $1.8 million in VST stock, which at the time was valued at around 64 cents. So we used our currency when the share price was trading really well to, to acquire a really, really strong asset in a great sector with a great team. Earlier this year, VST stake in Hydrate was valued at around 17.5 million. But since then, Hydrate's been growing by significant leaps and bounds. As you know, in our corporate update, I think we listed the new business partnerships that have signed up. So, we are really bullish on the sector and space. We acquired a great asset at a great price, using our currency at a premium. And since then, the business has grown dramatically. And so we've got this massive momentum, this massive flywheel going. And there are other reasons why I'm super excited. I mean, the list, so Hydrate's scheduled to list very shortly. And that listing is going to add significant value to VST's holding, as it already does. But when it's publicly traded, again, that mark to market will be, a really, really big valid indicator, and it'll bring new investors into the Victory Square kind of business and model. But as Hydrate is rapidly growing, it's Victory Square will post listing will still own, I think, around 70% of that business. So we're excited in that a really major holding of ours is going to continue to grow, and that value will show up on our balance sheet. We also have Victory Square Digital Health, which is a wholly owned VST sub that licenses software to Hydrate. So as Hydrate does well, not only do we benefit as the largest shareholder of Hydrate, but we also benefit off of licensing revenues that come back to wholly owned sub of VST. And to put this in perspective, I think with the growth of Hydrate, I think this year they're tracking to do between, I think, $8 and $11 million US top line revenue. And given their growth rate and what we're expecting growth to be like next year, multiples on businesses like this can be anywhere from 10 to 12 times revenue. So we're not only excited about where the business is today and what that growth rate is, but the exponential value creation on VST's balance sheet. As I'm mentioning Hydrate, I just realized, a lot of people might not know what Hydrate's business is. So I'll give you just a quick kind of synopsis of Hydrate for anyone that's kind of listening. One thing I think would be actually good too as well is, as I noticed there's a lot of questions around Hydrate, it'd be awesome if we can bring in Vahid Shababi to talk, to answer some of the other questions, because I think investors will really get a good deep dive from Vahid. And just to note, when we, after acquiring Hydrate, Vahid, Abby, and some of the other team kind of went full in, working with the Hydrate team, almost a full-time basis to really help grow and scale that business, which again ultimately benefits VST. But with them, with Vahid being sleeves rolled up and hands in that business, you'll be able to provide some really, really good data as someone actively in the business on a day-to-day basis. But just to give listeners kind of a quick recap of Hydrate. So Hydrate, has become a leader in providing nurses in the United States with a turnkey platform to participate in the practice of mobile medicine throughout all 50 states. In the US right now, there's about 4.2 million nurses. So it's a massive market that Hydrate's going after. Now, for those nurses, in order for those nurses to be able to, offer services outside of a clinic or hospital, they need to have a medical director, they need the correct technology, and they need proper licensing. And that's what Hydrate provides to them. Nurses are burnt out, they're overworked, and this allows them to have kind of their own business, whether it's full-time or on the side, to generate additional income. So Hydrate has built an all-in-one solution for nurses, including a white label platform, a medical director, a pharmacy, and all the required licenses so they can start their own mobile health and wellness service overnight. High level, just from financial highlights, like I mentioned earlier, we're expecting 8 to 11 million US in top line revs for Hydrate for 2022, and we're expecting about 2.3 million in EBITDA. Hydrate's been, on a cash flow basis, been cash flow positive since I think March or April, maybe even February of this year. Vahid would probably know better, but and they've got cash reserves. So it's sitting on cash that it doesn't necessarily need to use because the business, is performing well on a month-to-month basis, and that cash can be used for, strategic growth or M&A. So again, really healthy cash position, which again, like I mentioned earlier, during a time like this is super important, and a business that's cash flowing and growing. Business highlights for Hydrate. They've onboarded about 2,000 nurses and service providers since inception. I think it was cited in the corporate update today. They've got about 600% year-over-year new business partner signups. So if you haven't read our corporate update, check out the section on Hydrate. You can see the month-by-month new business partnership numbers. Tech, it's proprietary tech, fully HIPAA compliant. Digital services include telehealth, IV drip services, Botox, at-home testing, and other kind of medical and Metaspa treatments. It's US certified as an eScript and telehealth provider in all 50 states. They have a software platform that is fully customizable and licensable. I think earlier this year we announced that they had licensed to a chain of franchises in the US called Drip Bar, which is, I think, expecting to open about 430 locations across the US. They've got relationships with major vendors like Medline, McKesson, Allergen, which is the company behind Botox, and Galderma, full 503B pharmaceutical supply capabilities. So Hydrate owns its own pharmacy. So all of the nurses, all the new business providers that come onto the platform, not only does Hydrate receive a rev share, they're also, all the pharmacy sales are being purchased from them. It's been referred to kind of as an Uber for healthcare. Customers can book an appointment anytime, anywhere, with the same, kind of ease or convenience as booking a ride, or a ride sharing, or, online food delivery services. And again, there's 4 revenue streams for Hydrate. Subscription sales. So Hydrate, receives about $3,000 annually from each new business partner or nurse that signs on. And what's really exciting about this too is that this is recurring revenue. So on an ongoing basis, so when you look at that corporate update, you look at the new business, partner signups, there might be some turnover, but we're anticipating a majority of those nurses, re-upping next year, which is, again, there's no customer acquisition cost required, and that's all SaaS recurring revenue on an annual basis that Hydrate will get. I mentioned earlier pharmacy sales. So all of the nurses that jump on the platform, Hydrate receives 20% on all pharmacy sales, given that we own our own digital pharmacy. So that's, again, another great revenue stream. As the new business partners sign on, not only do we get that $3K annually, but we also get 20% on all pharmacy sales, up to 20% on all pharmacy sales that kind of come through there. There's also app sales. So, Hydrate receives 10% of all sales business partners generate on the app. And again, it's because we're providing them a HIPAA compliant app and technology platform stack that they need to actually be able to offer that business. And then the other revenue stream is on a white label sales side of things. So Hydrate receives 10% of all sales and 20% of all pharmacy sales on all the white label services. Last thing I'd mention just on that, which is another reason why we're super excited, given the growth of Hydrate, given this first mover advantage, given this flywheel effect that they're hitting, we've seen not only is the digital health space going to continue to grow, it was accelerated during the pandemic, but it's going to continue to grow. We've seen consolidation happen in this space, strong multiples. Health is one of those things where it doesn't matter if the economy is good or bad, people are going to spend on their health. And we've seen, 2 large transactions recently. One where Amazon acquired One Health for $3.9 billion. One Health in an all-cash transaction, and One Health was, an at-home care provider. CVS also acquired another company called Signify Health for $8 billion recently as well. And so we're seeing consolidation, we're seeing strong multiples, and both of those businesses were, that were acquired, were providing at-home care services. So we're really bullish on Hydrate, and we think it's going to, again, unlock tremendous value for VST and VST shareholders.
Great. A few questions to touch on. I know you did touch on some cash, but we did have some questions regarding it. When do you expect Hydrate to be EBITDA positive and cash flow positive?
This is probably a great, I don't know if we can get Vahid on, but this would be great for Vahid to jump on. As he's been kind of spearheading with Shane, kind of the Hydrate monster. over the last 12 to 18 months. So can we get Vida to pop on?
I'm here.
Oh, awesome. Okay.
Yeah, I see him.
Thanks, Shaf. On the hydrate side, I'd like to take a few steps back and then move forward with these questions. So when we acquired the hydrate, we acquired hydrate based on, I think, 1.6 or 1.8 million US based on mid 60 cents on VSD stock price. And the earnout was locked at 80 cents or low 80 cents VSD stock price to be issued. So, again, we used the high stock price. Then when we acquired Hydrate had a tech that required some work. They had pharmacy license 503B, which is a compound pharmacy license. And they had Friendly PC, which is a legal structure in the United States that if you want to provide any sort of digital health, you need to have that, and it's state-based. They had for about 30 or 30 plus states. Then back then, February last year, they were focusing a lot on med spas to be able to provide the med spa services at home, at the office, at the hotel. When we worked directly with the Hydrate team, we made a few changes in 2021. One, we invested in tech through VS Digital Health to have the co-ownership of the tech. Now, the tech is not only modular based that you can have one or two or three modules, can be sold as the white label pharmacy. It can be sold as a booking app, as a telemedicine app, or a combination of all, but also is capable to be white labeled to larger organizations. Because one of the issues that we had back then was large franchises like Drip Bar, they didn't want to be part of the Hydra network. They wanted to have their own network. So now with the new tech, it's easy to actually white label that and connect it to our pharmacy. So we still can get a percentage on the pharmacy sales and, payment processing, plus the licensing fee. Now, we also expanded our Friendly PC to be to 50 states. And the last major change was, instead of focusing too much on med spas, we focus on nurses. In the United States, it's illegal for nurses to, in most of the states, to provide services outside of the hospital unless they have a medical director, an insurance, and to work under Friendly PC license and have access to the pharmacy, which Hydrate creates that platform for them, that they can come on board, pay a licensing fee to be part of the network. When they come on board, then Hydrate will take 10% of any booking that happens on the app, and they have to order from our pharmacy. The pharmacy margin for us is different. We have anywhere between 15, 20% to even 50% margin, depending if we take over the inventory or we don't. And that small change played a big role in our growth, because based on our researches, there are three factors around nurses, especially after COVID. One, they are unhappy with the long hours that they spend at the hospital, and they're missing their family, even the small events that is happening around their family. Two, they're not happy with the pay, and three, they're not happy with the service that's being provided. So we targeted nurses as our first and primary. Then we went over the med spas. Now, the few thousand nurses that we have, you have to keep in mind, some of them is working from the same med spas. But I think last year, in the entire 2021, we sold roughly about 100 or 102 business partners. We call these nurses or med spas business partners. Last month by itself, we had 103 new, and I think we had 5 renewal, 108 new business partners joining. This month we're on track for about hitting 130 to 140, and we're going to have the same growth. And one thing that Shaf also mentioned, keep in mind, all these 3,000 to 5,000 that we get per year will be renewed next year, that then don't need to be onboarded. We don't need to pay the commission, and we're going to still getting more market share. Now, going to answer to your question, so we're becoming the Uber for the healthcare and Uber for nurses. In United States and in general, there are many services that the labs or some of the brands, some of the pharmacies would love to provide that at location basis, but they need to have a presence of a professional healthcare worker. That doctors are too expensive and too busy to provide that. The next thing is nurses. That nurses, the only way that they can provide some of those is to be under a license like Hydrate, that there is not such a thing in the United States right now, that there is no cost on our side to hire them. We're going to partner with them. So to answer your question on the cash flow positive and EBITDA, right now the Excel sheet that Shane and I monitor on daily and weekly basis is a cash base that we look at. The reason I want to say cash base is because we don't finance the licensing fee. The licensing fees due the very first day that people come on board. Now, we're gonna, we have this promotion that we're gonna run around the end of the year. That is $3,000 USD, and we're gonna increase that after. We get that on the first day. However, when you look at the GAAP accounting and you want to look at it from the auditor perspective, they're going to amortize that over 12 months. So we look at the cash base. If you look at the cash base of our business and look at the operating cost, and I tell you, what I mean by the operating cost, we've been cash flow positive since late Q1, early Q2. And when I say operating cost, because we had like a few major payments that we did. One of them, we took over some inventory on some, IV bags that it add to our margin when we sell those, because we're taking the inventory. So when I say operating is our cost for running the business, and VSD also had one bigger invoice to consult and help Hydrate to be ready to go public and all that, which is sitting on the books. But from the cash perspective, the business has been cash flow positive roughly about late Q1, early Q2. Just a quick example, like last month was our highest burn in last, but kind of by far in 2021, because we added multiple headcounts for onboarding and pharmacy and all that. And our burn roughly, again, these numbers are estimate, it was roughly about 160,000 USD. But if you look at just one line of the revenue item, which is the licensing fee, and we had 103 new business and 5 renewal, 108, that brought over $300,000 just for that. And all the money that came from the pharmacy orders and onboarding, and the service orders and white label was on top of that. Now, these numbers is a ripple effect because when we bring more business partners, the order on the pharmacy is going to increase, the app booking is going to increase, that is going to bring to the Hydrate. So to answer to your question, the business, again, has been cash flow positive on the operating side based on the cash base since Q2. And we're going to continue doing that. One thing about our, to just know how lean the Hydrate is growing, even after all the new hires that we had last month, our headcount, including the contractors, employee, and all that, is I think 19 or 20 people and running the entire operation right now. And there is no, when you look at the digital health, most of the businesses or some of the businesses, they have a lot of hard costs on the rent for, offices or labs or hiring full-time people to provide the medical services, which in our case, that's not the case. And we're just focusing on the fundamental of the business and growing it. Obviously, there, we're going through the growth pain right now, and we have to, maximize our operation and make the operation scalable as we're focusing on right now. But that's going to give you a high-level understanding as far as the end-to-end Hydrate of what it does and our position in United States for offering healthcare.
Thanks so much. And a few more questions regarding Hydrate too that I do see here. I think both of you touched on this. Can you share some business opportunities besides mobile hydration that you're working on that will bring additional growth to Hydrate? So
that's a very good question. And it's, in the extension of my explanation. Right now, because Hydrate is creating a platform to help different medical fields to be able to provide their services and products at home, because doctors are too busy and too expensive to do that. So right now, for example, we're in talk with a few national labs that they approached us. They want to be able to provide some of the at-home services tests that require a medical director and require a healthcare professional to do that. We've been approached by some, aesthetic brands that they want to offer filler or other, services at home. But again, they need to have a friendly PC, and the friendly PC for those services is a little bit different than the IV, because your medical director has to be in a specific radius of, the nurse when they're offering these services. So we're creating a great platform to be able to provide multiple different services and products at home, through our nurses. Even with some, conversation around the emergency services that are required to be done in different states and province and state cities. And in the United States, the rules and regulation is state-based, and sometimes we can offer some services and some products in specific states, and we won't be able to do the same in other states. And expanding our pharmacy products. Most of our pharmacy products are we own them, meaning for example, if there's an IV that it requires for immunization, or is for for a hangover, or is for for different purposes, our pharmacist, who's a pharmacist by trade, put these formulas together, and then we pass it to our partners to start producing those. Now, having these orders going up, our cost for these prices has gone so down that there are many franchises that are interested to use our white label pharmacy by itself, because everything is automated. They have the booking app, they have their own business, but so it's creating a lot more around us. So one will be adding additional services that Hydrate, by having these nurses, is going to be helping different brands and products and services to offer. Two, the white label side, both on the technology and also on the pharmacy side, is growing really fast, and we're focusing on that. And the lastly will be the growth in other countries to go after them. But right now we put our heads down and focus in the United States, because there are enough nurses that we can bring them on board and become that platform. Just again, if I want to use a similar example, the same way that Uber onboarded the driver, some came as part-time, some came as full-time, some started as 1 hour a week and then expanded it to full-time. Then they use the same force and the same group of people to start offering the grocery, and then the food and the Uber Eat and all that is growing. We're also creating a similar things in the healthcare by having our nurses fully equipped with what they need, and they kind of start providing these services.
Perfect. So that actually segues right into the next question. Where do you see Hydrate in the next 3 years?
Thanks so much, V, for popping on. One last note, just to what V mentioned, is one of the biggest strengths of what IV Hydrate's doing is the network of nurses it's building. So what Vahid just touched upon and is that strength is going to be that network, and whether it's from an M&A perspective to be able to offer other services within that network of nurses, or just being able to take advantage of what we're seeing as market demands with nurses in specific geographic regions. The value is always going to be in that nurse network, which kind of ties into where do we see in the next 3 years? I mean, from a Victory Square perspective, we anticipate 2 potential outcomes. I mentioned one earlier, which is M&A. The digital health space is growing; it's getting bigger. We've started to see consolidation. I studied those 2 transactions. Amazon's acquisition of One Health and CVS's acquisition of Signify. So we think that over the next 12 to 36 months, with this growth rate and market that Hydrate's dominating, is that it potentially gets acquired. The second is that it continues to grow organically and through M&A. It's cash flow positive. It's sitting on cash. It's rapidly growing, and it's going to be listed soon. And so I think its ability to continue that growth as is, we're super bullish on. And 2, with the cash reserves that it has, and a public listing, which we anticipate will be very strong, given that it's a very tight structure, they could use their currency as well, their share or their stock, to roll up some assets post listing if they see really good opportunity. I mean, I think we touched on it. There's going to be some really, really good buying opportunities, some good entry points for companies that just didn't manage cash flow. And Hydrate, again, being cash flow positive with their growth, with cash and premium share price, could potentially continue to significantly grow organically and through M&A. So those are the 2 outcomes. We expect it to just keep the machine to keep going and growing, or it gets acquired.
Perfect. Thanks so much. That was great. let's shift gears a bit here. Can you explain what Draft Label does and its business model?
Yeah, so internally, Draft Label is kind of an internal VST company. And what we do in Draft Label is we build and tinker with solutions. And when those solutions kind of materialize, they get kind of spun off. An example would kind of be the product that was sold to C&I earlier last year, where again it was just software that had been kind of worked on within Draft Label. So it's what we kind of use as to things that are being tinkered with in-house, solutions that we're building for pain points that we see. And so Discrete Care, which was a business that we created, a software that we created kind of within Draft Label, has seen a big opportunity. And it, again, just to give some reference points, again, digital healthcare and digital health space is something that we're bullish on. We've got this first mover advantage here with Hydrate. We've got things happening in Brazil with Safe Test. And so we're able to take all of those kind of key learnings, IP, tech team, is what we used to kind of build Discrete Care, which was, it was, B2B SaaS based kind of platform, pharmacy, and lineup of proprietary kind of formulations all around kind of treating sensitive issues. So whether it be ED, hair loss, STIs, nail fungus, fertility, et cetera. The business model is to target those customers and communities that have built communities kind of around those types of sensitive kind of subject matters. And Discrete Care would come in as a B2B, back-end provider for those companies who already have an audience to provide, compliant tech and pharmacy and, proprietary formulations for those companies. There are a couple of examples in market of companies that do something similar. Wheel Health is one, and TruePill is another. So what we did is when we saw an opportunity to amalgamate or partner up with a group that had $2.4 million kind of to grow and scale that business, and this would be a public listing as well. We took all of the other IP that we've been working on in Draft Label out and just kept Discrete Care in there and spun that off as its own. So it's now, again, Discrete Care is operating under Draft Label. The focus is on the digital health side. It's a B2B product, and really focused around providing kind of the back end tech, pharmacy formulations for like sensitive issue kind of market.
Perfect, thank you. Let's see. Okay, how will this, you touched on the next spin out you're thinking of, Draft Label, that will happen next year after Hydrate. How will the spin out of Draft Label benefit VST and its shareholders? When do you expect Draft Label to reach profitability, and what potential do you see for the new company? So, I mean, I think our model is we build, buy, or invest in things. So again, digital health space we like. This was something we built internally. So our cost to build is very, very low. So I think that, as this gets capitalized and spun off, the first big value to VST and VST shareholders is that, we are now getting another opportunity to validate our ability to build something, create value as we bring capital in. And that capital that's being brought in, it's non-dilutive to VST and VST shareholders, but it's allowing us to take this asset that had been kind of sitting there and turning it into something. And as it turns into something, that value, kind of rolls back onto our balance sheet, which benefits VST as a whole and VST portfolio companies. So, that capital that's coming in is going to allow that business to, to potentially reach its, or fulfill whatever opportunity or market it's in. And that capital that comes in, as it does so, it'll give VST another, and it's spun off, it'll give VST another, public holding that we have the potential to liquidate at higher valuations to, again, reinvest into, kind of top of funnel. So for us, we believe there's an opportunity in that sector. We have all, everything has been built. It was built in-house, low cost base to build in-house.
And now someone's giving us the capital to, to inject into that business, and we'll still be the majority shareholders, operating the business, controlling the board. But to have it turn into something which ultimately benefits VST.
Perfect, thank you. Next question here. Okay, so this one, someone wrote in 150,000 shares, 5 years. Please say something about your stock course. It's about to be a total loss, and since 5 years, there's only one direction. When do you think comes to turn around, and when is your aim for the future?
Again, this is a really tough, tough to forecast what's going to happen, when the share price will turn around. I mean, I think, we're upset at the share price, but we're not concerned, because again, we believe in the value of the underlying value of the business and the prospects of the business and the portfolio. If I looked back at our chart, our share price has jumped up and it's come back down, and it's jumped back up again and it's come back down. And so we've seen a lot of volatility in the stock, I think, since September, October of 2017. So, from an operational perspective, what we've done is when the share price has gone up, we've utilized that premium currency to acquire assets. In 2018, I think we did like 12 or 13 deals, using our share price as a currency to get really good opportunities for VST. But it's gone as low as, I think, we started 2020, I think, at 5 or 6 cents. So we've seen the share price go up and down. When it's up, we utilize that time to take advantage of bringing really good assets kind of into the portfolio. And when it's down, again, we just double down on the operational side of the business and keep building. So as to forecast when it's going to come back again, I mean, I think one thing that we see from a macro perspective is we think the markets are going to be volatile for the next couple of quarters. But with specific companies like IV Hydrate and some of the other things we're working on, we believe that the NAV will continue to grow. And so, hopefully the turnaround is sooner rather than later for VST. But again, it's very hard to forecast when the share price is going to turn around. All we can control is like the execution of the business. We'll continue to update shareholders with the NAV, continue to provide corporate updates. As we get our companies mature and spun off, we'll continue to do so. But the market is one thing which we haven't never been able to kind of predict what the share price is going to do.
Perfect, thank you.
Sorry, but one thing is, we're confident that long term and over time it'll go up. Like, there's no doubt in our mind long term. I think it's this short term volatility that it's hard to predict.
So that's great. Actually, someone wrote a question very similar, kind of leads off of what you just said. So we realize that the market controls the stock prices. However, the concern is that VSQTF is not making any money, or more to the point, they're losing money every quarter. Can you elaborate on this?
Yeah, so we have no plans on doing an equity raise at these share price levels. I think I mentioned earlier, we announced in September, we secured strategic debt. I think it was around $2 million. This debt was, again, secured by putting up some of our publicly traded assets. And I think we even have the option of paying the interest in shares of our portfolio company should we choose to do so. So very strategic, very favorable to the company. Our burn is very low. So that, again, that capital allows VST, and it was non-dilutive. That capital allows VST, ample runway, to kind of get through any sort of like prolonged downturn. But I mean, I think the other thing from a long-term perspective is, we've built up, significant assets. So just like in that case, we were able to borrow against our assets, should we choose to do so, we always have the ability to borrow against our assets, sell our assets, and if the share price appreciates, to do an equity financing. So there are multiple, we built the business with strong fundamentals to give us optionality, favorable optionality. So, one is we currently have a healthy balance sheet, so there's no need for capital. Should we choose to, for VST to go and get capital, again, we would look at, the first thing we would look at is, is there capital to be had by spinning off an asset, selling some assets at a premium, or securing, strategic debt against them. The other thing I would say too is we know that there's not really a big burn required from a VST parent company perspective, because like I mentioned earlier, we too are looking and saying, hey, let's first spend the time focusing on some core assets, IV Hydrate, getting draft label listed, strategic guidance for Game On and XR Immersive. So we're not looking to be aggressive right now. If you look historically, 2018 share price was trading high. We went out and acquired a lot of assets with a premium share price that we worked on and that have provided value for us over the last couple of years. When the share price was low, we didn't do any equity financings. We tightened the ship, and we really just focused on operating and growing and building our businesses. And so yeah, there's no concern about cash. There's no concern with cash. We're not concerned about dilution, and we've got a healthy balance sheet and significant assets. One thing to note too, our business, our financial statements are really confusing, and we're working with this new auditor to help kind of break them down and simplify them, because they're consolidated, so it brings in numbers of portfolio companies that deem that we have considerable holdings or a material stake ownership in. But two, our business is not a business that is meant to necessarily make money on a consistently on a quarterly basis. Our biggest KPIs are cash in and NAV, right? Really, our goal is to build, to use our cash as wise as possible to create the biggest ROI, to continue to compound the value of those assets under our balance sheet, because that's our currency. So, it's very hard to predict earnings on a quarterly basis, or are we making money, because it's not our business model. Our business model is to, again, find, invest into, identify opportunities, buy, build, or invest in companies within those opportunities, and to try to create outsized returns in those, in those opportunities. Be very, cautious on our cash invested and the, ROI we're seeing from an asset perspective. And so, yeah, I mean, I think we're in a good, healthy balance sheet, significant assets. We're not concerned about that.
Thanks so much, Shaf. Okay, so I bought shares in the company based on past large dividend payouts to shareholders. Will there be another distribution anytime in the near future? There's a few questions on this one.
Yeah, so the dividend strategy was to benefit, VST shareholders and VST as a parent company, I think, and to build a base of shareholders for our spinoffs. In 2021, we gave 3 common share dividends, and it didn't have a positive effect on VST share price, or the investors, or given that the share prices of those companies have declined, and for the portfolio companies, because there was a lot of downward selling pressure for those portfolio companies as they're just trying to get their feet wet. And so I think all around, we really believe in this idea, and I think it was that probably had more to do with the negative sentiment and decline in the microcap space as it did in kind of being a bad idea. So we still like the dividend strategy, but I think what we're going to do now is wait until the end of the year, kind of reassess the overall market climate, the stability of the business before we do, any more dividends. So we like the strategy. We just want to make sure we're not hurting VST or our portfolio companies, which again, in turn hurts VST. And in talking, I know I like beating a dead horse here, but we're really, really bullish on IV Hydrate. And so, it's listing shortly, hopefully by the end of this month, beginning of December. But, we've got a very tight structure on that. There's very little stock available in that company for investors to get, to be part of. And so we really want to make sure that it trades well. And it trades, not only does it trade well, but it trades where it should be trading. which is, at a premium, not, discounted like most of the microcap space is. So yeah, sorry, long-winded response. Like the dividend strategy, we're going to reassess at the end of the year, because again, we want to make sure that strategy is beneficial for VST portfolio companies, and it makes sense for investors. Because investors, if you're getting a share dividend, we'd rather you get it in a company that's already built, it's got its feet wet, built its market, built, has been executing, so that those shares can be, absorbed if you choose to sell them.
Okay, thanks so much, Shaf. I think we should do, just given time, we should have a few more questions here before we close out, and just kind of wrap it up with you. I guess why should people invest in VST today? So
again, I feel like this is kind of a loaded question. I want to take a step away from VST for a second, and just, because I think tens of thousands of people kind of turn to Google every month asking if, now's a good time to buy stock. And I think it's a loaded question in general. I think a lot of this depends on an investor's, like, your investing goals, and the time horizon of what your, investment goal is. Because right now, on any given day, on any given week, the markets are volatile. And so, we're not short-term investors, we're not day traders, we're long-term investors. So I think a lot of this, I think each of you have to first figure out, like, what is your investing goal? What is your investing, timeline? And even more so, for an investing goal, we've seen interest rates jump. There's been rampant inflation. So, ensure each individual person makes sure that they have savings, to invest. I mean, that they feel ready to buy stocks, and they don't necessarily need money next quarter or next month or next year. I think, there've been a lot of lows and a lot of highs, but again, for us, we believe that if you're invested long term, you'll do well. And the markets over time historically have always kind of done well. So I just want to start with that caveat, please, for each individual person, we don't know what's going to happen over the next quarter, 2 quarters, 3 quarters, 4 quarters. There's a lot of macro things happening. So first, please make sure that, you've looked at what your savings are, you've determined what your investing goals are, and you're very clear on what your investing time horizon is. Now, from a VST perspective, 3 things that I would touch upon. One is entry point. I think there are times, and today is a time, like this market is a time where investors can find really, really good entry points in stocks. And so, VST is trading, I think, at an 85% discount to its NAV. I think the market cap is an 85% discount to its NAV. And there's not a lot of stock out, stock's very thinly traded. So I think this is a good entry point to dollar cost average, or to, take a position in a company that, second big thing is there's a number of catalysts, right? So, the business that we own, that we're going to own 70% of in IV Hydrate, it's going to list soon, and it's going to be its own public entity, and how it trades and what its market value is going to unlock onto VST's balance sheet based on our, 70% ownership post-listing of that company. So again, these are some big catalysts that are coming that I think are going to showcase and validate additional value on our NAV, but also new eyeballs, right? Again, it's a specific business in a digital healthcare space with lots of business partners, lots of customers using its platform. So I think it's going to bring exposure to a lot of new investors that can learn about the VST story. And then there's, again, I think there are a couple of other listings we have, but I think, just focusing right now from a big catalyst, short term being Hydrate. And then I think ROI, like why we invest, or why should someone look at VST? Not only is it trading at a discount, not only is there a big catalyst, on the horizon, but we expect, to double our NAV over the next 12 to 36 months. And so even at its discounted value today, we believe that NAV will double. So there's even additional room to create value. So, I touch upon those 3 things, as reasons for that.
perfect, thank you. Let's do a few more questions since we did.
I can.
We're a little late getting started.
I'll look in here, and just a note, if we don't get to the question, what we can do is put the list of questions that aren't answered into the Discord channel, so we can get to them. So I actually can see the questions. There's one question here: is there a release date for Q3? So our Q3s are due end of this month. So I think it's November 30th. So they're scheduled to be out by the end of this month. What steps are you taking so that share price or Hydrate doesn't tank right away? So again, we understand the market cap space is there's a lot of negative sentiment right now, no momentum. But one of the things we did with Hydrate is we kept a very, very tight structure. So I don't know the exact number, which I can get to, but there's going to be very, very little stock available when it lists, and all that stock that will be free trading, I think, are all people that are that have come in through kind of a the president's list or I think a close friends and family a VST shareholder round that is, I think, long term on the business. So even if they were to sell, there's not very much stock out. So that's one of the biggest things we did, is to have a very, very tight structure, very little stock out that's tradable. And all stock has I think an average cost probably around 63-64 cents anyway. So there's no free stock or anything like that out there. One other thing too, again, is that this is a business that from a communication perspective, we anticipate to continue to announce solid news to the market as it goes on a more regular basis. It is one business as opposed to VST. Everyone knows it's a really hard business for people to gather because there's so many different portfolio companies. The third thing, which I think will be really beneficial for Hydrate, is that Hydrate not only has all these new business partners that are like built into the network. Each of those business partners provide services for an end client or consumer. And then all the business partners within Hydrate's ecosystem, all of them will be, it'll be communicated to all of them that Hydrate is listing its ticker symbol. And so it's got an interesting reach in that it's customers that are spending $3,000 a year to be to license its tech will also have an opportunity to buy the stock. I mean, he talked about Uber. The example is if Uber drivers at the very beginning had an opportunity, like the first drivers that were on the network had an opportunity to buy stock in Uber at that time, it would have been an aspirational opportunity because the value of that stock would have been worth more than what they would have generated from providing the service, as a driver or food deliverer for Uber. So I think this is going to be a really exciting opportunity for a lot of those business partners to aspirationally own part of a company that they're they're like almost founding business partners of. So those are the steps that we're taking for that. Next question: is Fans going bankrupt? What's your take on them hemorrhaging money? So no, we don't anticipate them going bankrupt at all. I know that again their share price is declined significantly. They announced their Q3s, I think, today. We really believe in that sector and that team and that tech long term. I mean, it's very unfortunate what's happened to a lot of share prices. I know a lot of people are, were upset about the American affiliate transaction and the dilution from that. But we believe long term in that, business. We're large shareholders. We believe in Darius Scott and that team. I think they announced, I think recently, some strategic debt that allowed them to clean up some entries that will prevent a lot of dilution in the stock. But again, from a market perspective, it's really hard for me to explain. I don't think they're going to go bankrupt. Again, we've been behind that team for a long time. Like the space, like the team, like the product. I think internally we used to have this saying, Fans Unite will never die, and I don't think it will. I think it'll continue to grow, and they'll get through this. Are you still seeing a lot of opportunities crossing your path? We do. We're seeing a lot of opportunities, not only from a general perspective, but we're seeing opportunities within specific portfolio companies, because in those sectors, a lot of businesses that didn't manage cash flow properly are running into trouble. So we are seeing a lot of really good opportunities right now. But like I mentioned earlier, the big focus for us and what we're telling all our portfolio companies: make sure you're cashed up to get through the downturn. get as lean as possible and focus on your core businesses. Don't take any undue risks right now. And so that's kind of been the, you know, the mantra right now, currently, kind of with VST and its portfolio companies.
There's a great question, Shaf. It says both Get and VRAR had tight share structures, but both went down by the time people that participated in the financing got their shares. What makes Hydrate different? I think that's a good one.
Well, I mean, so this is a really good point. So in both cases, the share dividend. So in the case of Immersive, I think there were 9 million. We issued 9 million common share dividends, which pretty much had a zero cost base for investors. And so again, a lot of downward pressure. So what we saw were a couple of things. If you look at Game On or VRAR's trading patterns post listing, I think in Game On's case, it, you know, jumped and then it, you know, kind of declined over. And I think a lot of Game On's case, I think, had just to do with a negative sentiment around microcaps, that sector and space. We've seen it in a lot of names in that category have declined. But also, again, you know, shares out there with no cost base, I think, you know, also kind of accelerated and exacerbated that kind of decline for Game On. In the case of VRAR, you know, the stock jumped and there was a lot of volume in November and of last year, sorry. And but you know, I think at that time they'd hit kind of a down market. So you know, you have all 9 million shares at the market with no cost base, but no new buyers kind of coming into the entire microcap space at that time. So I think that both had tight structures, but not as tight as Hydrate. In both those cases, there was a lot of stock. There was a lot of stock from the common share dividend that had no cost base, and you know, and I think there still was more stock out. However, in both of those cases, we expect both of those companies' stocks to rebound when the market comes back, primarily because, again, they've avoided dilution. They've avoided significant dilution. Both, you know, took advantage of strategic debt. So in both cases, you know, the majority of the stock is still owned by insiders. A lot of the float's been turned over and consolidated. And so again, we don't know when it's going to come back, but I anticipate both of those companies, when the markets come back, again, don't know when it's going to happen. When they do, their structures are still tight, and I think that they'll rebound. We anticipate them rebounding quickly.
Okay, just for cautious of time, maybe one more question, Shaf.
Okay. Are there shares used to buy Hydrate? Are the shares used to buy Hydrate already paid, or do you have to issue more shares to complete the deal at today's prices? So no, the shares used to buy Hydrate have already been paid. There were some shares that were part of an earnout, but the pricing was set at a higher level. So there's no concern about dilution or any sort of payout to VST's thing now. All of that stuff has been completed.
Perfect. Thank you so much. If we didn't get to your question, please feel free to shoot us an email at ir@victorysquare.com, and we'll definitely answer it. But we thank everyone for joining us today for this Q&A webinar, and we look forward to connecting in the future. Again, this is being recorded, so I will be getting this out as soon as possible. So we'll be sharing it in the Discord, and I'll send an email out after, so you guys can all refer back to it for some of you that may have just joined us a little bit late. So thanks so much for everyone for joining us. Any last words, Chef?
No, thank you, everyone. Yeah, we'll keep, if you didn't get a chance, check out the corporate update, which went out today. Tune in tomorrow. Game On's got Matt's going to be doing a webinar, so anyone can get a, you know, kind of a deep dive into what they've been up to and what they're doing. And yeah, we're looking forward to IV Hydrate's release. And I think one of the things we wanted to do pre-listing, if anyone's interested, is to set up a webinar and, you know, provide some information so investors can get, you know, a deeper dive. And again, thanks Vahid for popping on, and for you, Abby, for moderating.
Thanks much, everyone. Have a good evening. Bye now.